Welcome to the monthly MOTR Checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. The name of this month's video is "The Ingredients for a Bull Market Are Finally in Place," and we'll get into that in a moment. But I wanted to give you a quick moment to take a look at the disclosures for the month. Okay, so the ingredients for a bull market are finally in place. What are we talking about here? So obviously the S&P breaking out to new highs, that's a necessary ingredient to confirm a new bull market. By definition, you can't have a bull market without higher highs. So this is obviously a good and important step. It follows similar new highs from the NASDAQ and technology sector and industrials and a few other things. But broadly speaking now, we have the S&P breaking out to new highs. Of course, we have small and mid-cap indices nowhere near that, but that is in the making, I believe, for 2024. The reason I believe that is because, most importantly, for the past 2 years, we haven't had any confirmation from the underlying breadth structure of the market. So as the market has rallied without the confirmation of the underlying breadth of the market, we've noted that the rallies have failed. And of course, that doesn't look to be the case given what the Magnificent Seven did. But as I'll show you and remind you, the fact is that most stocks have gone nowhere for 2 years. And in fact, as of last October's low, they were down about 30% on average from their peak. So that bear market that basically consumed the equity space for the past 2 years is over. And I believe it's because market breadth is finally inflecting positive. Leadership remains cyclical, and it's spread amongst many sectors and industries. So beyond the Mag 7 in mega cap names, there's a lot more to choose from than might meet the eye when you're thinking about what's been driving the market higher. So finally, this is all starting to spread out, and there's a lot more to choose from than just these mega cap growth names. So along the lines of security selection, given my philosophy, you should always be favoring stocks that are trending and outperforming. That way there you're aligned with the market's opinion, which again, I think the market's the best fundamental analyst on the planet. It's the best macro strategist on the planet, the best economist, political strategist, et cetera, on the planet. And so the way that it expresses its opinions is through stocks that are trending and outperforming. These are the stocks that have, in the market's view, have the best characteristics to weather the storm or make hay while the sun is shining, which I think is what's coming in 2024. But from here, though, and I'll kind of walk you through why I think this is the case. But you really want to focus on companies that have superior growth and valuation characteristics, if possible. Not always the case that it's possible, but if you can find them, that's where you should migrate to. And then lastly, of course, the media and investors and FinTwit and everything else, they're really consumed by this battle between the market caps of Microsoft and Apple. And quite frankly, it's an ongoing battle, a war, I should say. It's been going on for quite a while. It's just in the middle of another battle as we speak. And I would just say, who cares? It doesn't really matter. There's a much bigger war going on and being lost, actually, as we speak. And we'll talk about that as well. So the S&P being at new highs is, of course, as I said, by definition, it's required to confirm a new bull market. But beyond the new highs and the fact that it's a step in an important, unavoidable step in confirming the bull market, the reason it's important is because we can now identify those former highs as being support. Now, we've already done this. We've already highlighted this level, this 45 to 4,600 over the past couple months as being the level that needs to hold. But now that we're breaking out to new highs, it really solidifies this area as being the support zone that needs to hold. And it doesn't appear to us that we're going to get a deep pullback into that range. But the way we try to think about it without having too much expectations, the way we think about it is the market can do pretty much anything it wants to do as long as it does it above 45 to 4,600. And so that way there you have your mind and your expectations are kind of wide open in terms of what could happen. But in terms of what can't happen, it's a much more narrower set of circumstances that you really want to monitor for. So without being putting too many expectations on what the market must do going forward to satisfy our quote unquote definition of a bull market, let's keep that open. and just say that it can do whatever it wants as long as it's above 45 to 4,600. Now we've obviously along the way we've been focusing on this base, and of course this base is more clearly defined in the small cap indices and the value line, which we'll review in a moment. But nonetheless, you can still identify this base, call it a double bottom, whatever you want. And now that we're going out to new highs, the value here is that we can now project upwards to the target for this base, which is basically just taking the depth of the base and measuring upward from the point of the breakout, which the breakout was here. So just measuring upward gives us a target of roughly 5,100. So I would think as long as the structure of the market continues to improve at the margin, which it does, this should be a minimum target. So if you wanted sort of like a whisper number where I think we can actually get with slightly more aggressive pattern recognition and breakout targets, we can get up to 5,700. So the idea is that somewhere well north of 5,000 should be within the realm of possibility for 2024. All of this is great, but the most important point, though, and the reason why this is a sustainable, not sustainable, but an achievable target, 51 to 5,700, is because the breadth of the market has finally improved, and it really began to improve in the fourth quarter, but we're beginning to see it just continuing to get better and better. So today, when we look at our trend model, which is measuring trend across 3 time frames, so this, remember, short term, medium term, long term. Want to re-stress once again, this short-term chart is the weekly chart for me. So I don't really look at daily charts and hourly charts, and certainly 15 minutes and things like that. I don't really care to look at those, not because they're not value, but it's just because it's not in the time frame that I'm trying to capture. I'm trying to capture trends that are driven by fundamentals, and once you get into those short time periods of daily and hourly and whatnot, you're really kind of divorcing yourself from the fundamentals, and you're really kind of wading in the weeds of the emotional response to fundamentals and other short-term capital flows and things like that. And I'm not trying to capture those trends. So my short-term chart's the weekly chart. This is the monthly and this is the quarterly. And we can see down here that in all 3 time frames, and including when measured by market cap, the majority of trends are now positive. And this is the first time it's been like this for 2 years. So this is the required ingredient for a sustained bull market. And we haven't had it for 2 years, haven't had it since 2021. And once again, I've mentioned in the past that I've done this analysis using this trend model back to the 1950s using survivorship bias free data. And this is how markets bottom. And so we finally have the ingredients for a bull market. When you look at the subcategories of trend, you can either be in an uptrend or a positive base of an uptrend, or a negative base of an uptrend, or you can be in a downtrend, or a negative base of a downtrend, or a positive base of a downtrend. And when you look at those potential buckets of trend, and you try to see where is the biggest bucket across the time frames, whether it be market cap or breadth, you can see that the biggest bucket is an uptrend, a clear uptrend. So not basing at all. It's just higher highs and higher lows. The only area where we see where we see the biggest buckets is down here with these negative bases in this short-term weekly time frame, which is a function of this little pullback that we've had. It shows up more on the value line, which I'll show you in a moment. But the main thing to keep in mind with all of this is that, and this is a theme that's been recurring throughout my research over the past 2 years, is that when the long-term trends are negative, whenever you get positive developments in the short term, more often than not, those positive developments in the short term, they're positive in the short term, but they're not strong enough to inflect the long-term trends. They actually become traps for the bulls, and they actually become, all that positivity becomes actually a negative sell signal. And we saw that playing out a number of times throughout certainly this bear market, and then in through here, and then even up here where the value line was still down, within this base. This pullback on the value line went all the way back down to these lows. So that was because the long-term context was still negative. Now we need to flip that on its head, because once again, the long-term context is now positive. So any short-term weakness, I view as being a trap for the bears. And so you actually, this is quite healthy to see our ability to pull back, and they're still in an uptrend. They're just bases of an uptrend. They happen to have a negative bias at the moment, but these negative setups on the weekly chart, the short-term weekly chart, are actually buy signals because the long-term trend is positive. And I would put, in addition to this modeling process, I would put things in here like like a bearish MACD cross on the daily or the weekly chart. Those tend to be buy signals actually when the longer term structure is positive. Or when you see like the McClellan oscillator. These are all things that I've written about recently in research, in the research notes. But when you get negative sell signals from McClellan oscillator, when the long-term context is bullish, those negative sell signals in the short term are actually better buy signals than sell signals. And so be mindful of that. So when you see deterioration here, this is just setting the stage for the short-term basing process that traps all the bears, and away we go. And we're beginning to see that now, actually. Okay, so on the value line, you can see a marked difference between the base on the value line and what we see on the S&P. I mean, it's quite a difference, and it's why the bull market up until now has been unsustainable. But nonetheless, you can still see a similar basing process. But as I mentioned earlier, the S&P broke out here, had its pullback, and now it's up at its highs, and we haven't even broken out on the value line yet. So that's obviously the disconnect. And up until recently, these disconnects have been not necessarily alarming in the sense that they're bearish, but more in the sense that that the bull market that you're seeing in the other indices, the cap weighted indices, is just ultimately unsustainable. And I walked through this last month with some charts showing the long-term history of this average relative to the S&P, and how it's never moved opposite of each other. They always move in the same direction. So this disconnect has been something to be mindful of. But more recently, as I just showed you in my modeling process, there's actually more trending now in that long-term time frame. We don't see it yet in the value line, but this is why I model every stock individually, because I'm trying to capture and identify trend changes and inflections as quickly as possible, and the process that I use captures it even faster than the value line. But the idea here is that if this is all these inflections are sustainable, then we should turn right about here. And we of course last week saw a pretty nice turn off of support, but this is your support zone, which we've identified recently, and would just reconfirm that this is the important zone for the value line, 550 to 570. And from here, we should move out to new highs. If that's the case, then we can do a similar base projection procedure here, where you just measure the depth of the pattern, and you just measure it up from the point of the eventual breakout, and you get 715. Now, if you do the math on this, obviously the average stock has upside of 25% compared to a potential maximum upside on the S&P of 18%. So this would suggest that as the bull market gets going, it's not that those mega cap stocks won't do well. It's not even that they won't outperform. It's just that they're not the only game in town, and there's more places to be, arguably potentially better places to be. So we want to be mindful of the opportunity to broaden out the portfolio into not just different market cap tiers, but different sectors as well. So where is the leadership today? Well, it's still industrials. Industrials have been number one, number two, or number three for, I don't know, it feels like 18 months or so. But you can see it's currently back to number one again. And number two is technology, and number three is financial. So when you look at this setup, I mean, once again, it's very cyclical. It's got plenty of room to go, because you can see that the three leadership sectors are all in risk on, which is great. Even the long-term risk gauge for the industrials is actually in risk on. This is very important. But as I've talked in the past about how this whole trend process is they're linked to one another. So like we call it fractal, the fractal in nature, in the sense that the long-term trend can't get better until the medium term gets better, and the medium term can't get better until the short term gets better. And that's obviously the process that we've been following all along here. And now we've seen strong improvement here, leading into strong improvement here, and now finally strong improvement here. So that's what's got the breadth condition improved to the point where we can now anticipate a sustained bull market. Another way to think about the fractal nature of trend is that if we're waiting for the market to get into this risk on across the three timeframes, which again is what happens in bull markets, if that's going to happen, the fractal nature of trend improvement or trend evolution is such that the broad market can't get into risk on in this long-term time frame unless the leadership does first. And so we can see that the only bucket that's in risk on is industrials, the only sector. And technology is down here at 6, financials are down here at 6. So you could look at that as a potential negative because they're not in risk on yet. But the way I prefer to think about it, and the reason I say prefer to think about it is because you can see that the trend inflections are all positive. So this looks to me like in time, in the months ahead, all of these things will go into risk on. But the fact that they're not in risk on yet actually tells us how much fuel there is left to burn in this bull market before we have to actually worry about the end. So we're not even in risk on yet. So this is still very much, regardless of what the S&P is saying and the fact that it's breaking out to new highs and everything else, the vast majority of the market, including the leadership, is nowhere near to even being in risk on yet. So we still have a lot of room to go before you have to, begin worrying about deterioration. At the industry level, as I always say, fish where the fish are, and you look at this this leadership. This is your current industry rank, and you can see ranked best to worst. You can see a number of leadership industries in here. So you from the leadership sector, so industrials, financials, and tech. That's great. But we also have materials. We have energy, some discretionary, and healthcare. So as I said earlier, this is a very broad, well outside of the Magnificent Seven type of a leadership. It's been like this for quite a while, but now the market's beginning to inflect more broadly from the bottom up. So we should start to really see this market gain some headway here. One thing to consider here is if this is your leadership now, this is where the ranks were 3 months ago, 6 months ago, 9 months ago, and a year ago, and you see a lot of red over here, telling us once again and confirming once again that this is just getting started. If this is all green, and we're green now, then we'd have a bull market that's obviously clearly been underway for quite a while. But the fact that most of this is still red from just as much as 6 months and 9 months ago tells you that once again, we're just getting started. When you look at the percentage of stocks in these industries that are in an uptrend versus in the long term, medium term, and short term, there's only one industry in the leadership that does not have a majority in the long term uptrend. The rest of it's all a majority of stocks in an uptrend. So again, the reason that's important is because just because we're in a bull market doesn't mean we're not going to get market weakness. We always get weakness, both bull and bear market. The difference between a bull market and a bear market is when you get weakness in a bull market, that weakness actually triggers buying, versus that very same type of weakness in a bear market triggers more selling. And so you get new lows. So the essence of higher highs and higher lows is an expression of confidence. We see lots of confidence across these industries. So when we get pullbacks, we should see that should incite buying, not selling. And we can see the trend structure to support that notion here. Okay, real quickly on thinking about stock selection, and I guess philosophically, what kind of leads me to where I am in my stock selection process. So if you think about the styles of investing, obviously there are many different ways to do this, but there are essentially three styles. There's and they're all represented in this formula. There's price, which is momentum or trend following, which is what we really focus on. Then there's fundamental, which is growth investing, and then there's valuation, which is value investing. And obviously, there's this age-old notion that there's a battle between these different camps in terms of what's the right way to do it. And what I've been arguing for years is that there is no battle, and that's kind of patently obvious because we're all operating in the same formula. So there is no winner here that wins without everybody else. So no matter what we think about the price setup, and no matter how much work we do and how much modeling and hours of laboring over the data, looking for conclusions to warrant risking capital, no matter what we conclude based on the price analysis we do, we're not going to make any money without cooperation from the right side of this formula. And the opposite is true as well, where no matter what a fundamental manager or investor might conclude with respect to the quality of the fundamentals or the outlook for the fundamentals or the valuation, no matter what that investor concludes, that investor will never make money without cooperation and agreement from price. So when we think about it, yeah, I would just reiterate that there is nobody on this planet who believes in fundamentals more than me. And I think you can see from this formula why anybody who doesn't believe in fundamentals are important is just obviously really misguided. But the reason I don't inject my own opinion of the fundamentals is because the markets are pretty, as I said earlier, I think the market's the best fundamental analyst on the planet, and it's demonstrated itself to be as such because it's hard to beat, right? So that means that the market's a pretty good fundamental analyst. So price is the market's opinion of the fundamentals. So, as much as I can identify good fundamentals and what potentially might be good valuation, that's an important step in the process, but I will never invest according to what the right side of the formula without agreement first from the left side of the formula. So I need the market to tell me that these are the right fundamentals and the right valuation setup. And of course, when you look at this formula, you just kind of step back at a higher level. This S is sentiment. And so in a bull market, this S is a number above 1. So it's to the power of 2 or 3. And obviously, the more bullish and optimistic people get, that bigger that number gets. And then in a bear market, this sentiment becomes a fraction. And so it becomes a square root or a cube root. And it really, that sentiment depresses what people think about the fundamentals and the valuation, and that feeds through to price as well. So you can see how all these different inputs come into the same formula. And so all that being said, this is how we bring these three things together in our quest for stock ideas. If you make a Venn diagram out of these three inputs, where you have the intersection of all three of them here, this would be price, fundamentals, and valuation coming together. If you can populate an entire portfolio with stocks from that intersection, your job is done, right? Because as you can see, that's what's going to drive good outcomes over time. It's not always the case that you get those combinations. So sometimes you need to compromise on one of them, but it's never price. You always go with price. Price must be in an uptrend, but there are times when you can find positive price with positive fundamentals, but the valuation might seem questionable to you. But that, again, that's, as we all know, valuation is not a great timing mechanism. In other times, we can find strong price with decent valuation, but the fundamentals aren't quite clear. But the fact that it's trending in a fundamental time frame tells us that the market is telling us, it's the market's opinion, that those fundamentals are going to get better. They just don't appear to be good right now, which is fine. But these are the two sort of alternative combinations outside of this number one spot here. And then, of course, thirdly, you can have stocks that are just demonstrating price in relative performance, but on the surface don't appear to have justifiable fundamentals or valuation. And again, what the market's telling us is that it believes that these things are going to get better. And a good example of this would be energy in 2002 and 2003, where it didn't quite appear logical that the energy space would be leading out of a bear market bottom. But fast forwarding a year or two later, we realized it was Japan, it was China, and the big build out in materials, and of course everything with materials and energy as it related to the home building boom, et cetera. So this is why you need to focus on all three of these combinations. If you can build an entire portfolio with this, that's great. But be open to these other opportunity sets as well. And then, of course, at all times, we have these watch lists ongoing as well, where we have some combination of fundamentals and valuation, but it's not trending now. So we want to constantly be doing that work to find the best fundamental companies, but we do not pull the trigger until we get price, because price is non-negotiable. This is the market's opinion, and we will never make money on any of these fundamental and valuation assessments that we make without price confirming that view vis-a-vis price uptrends and outperformance. So this is how we think about it. And when we put together ideas in our chart packs, and of course in the portfolio we manage, this is pretty much the map we follow. Now, as it stands today, we do have a fundamental quality model, puts stocks in 10 different deciles. And you can see over here, there's the top 5 deciles and the bottom 5 deciles of fundamental quality. And the benefit of when you pull fundamental quality and price trend together, you can look at how the various deciles stack up relative to the broad market. So as we indicated earlier, 43% of the market is in a clear uptrend without basing or anything else. So it's the biggest bucket of trend in the market. So here's just this summary line right here is just for the motor universe, which is 2,600 stocks, and there are four buckets of potential trends. So there's an uptrend, there's an up base, and downtrend. So all four of these columns going across should add up to 100, and the biggest bucket is colored in blue. So 43% of the motor universe is in a clear uptrend, and that's the biggest bucket. This number doesn't quite match the previous slide because not every stock in the motor universe has a fundamental quality rank. So, but nonetheless, directionally, they confirm each other. So when we do this analysis and we say, okay, let's look at the top decile of fundamental quality and see where are those stocks today, and we can see that 61% is in a clear uptrend, and very few of them are in a clear downtrend. And that analysis plays out all the way down the fundamental quality deciles. When you do the same analysis on the lower fundamental quality deciles, you see that in the down base, the majority, or I should say, the most of the deciles of poor fundamental quality show the largest bucket of trend is in the down base, which is potentially, as it's identified, as a potential base, but nonetheless, it's still in the downtrend. So we can see by looking at this that the market is making a very clear distinction between fundamental quality. And we believe that unless and until that changes, we're going to want to make sure that portfolios are mapped this way. Now, another way to look at it, instead of looking at it across to see where the deciles are, you can also look at it vertically and say, well, where are the trend buckets? So when we look at all of the stocks that are in an uptrend, we can see that the biggest bucket of uptrends is in the top decile of momentum. And then when you look at of the stocks that are in an up base, the biggest bucket of up base is the third decile of quality. So you can see that there's a significant preference, once again, amongst the trends, positive trends, for quality stocks. And if you did just sum these 5 deciles, you'd get 58%. So 58% of the trends, these uptrends, are in the top 5 deciles of fundamental quality, and the same is here, 64% for up bases. Now contrast that with when you look down the downtrends, the biggest bucket of downtrends is the bottom decile of fundamental quality, and same thing over here with the down bases. And when you add up these 5 deciles, only 36% are in the top deciles of fundamental quality. So you can see once again on these two ways of sort of slicing and dicing that this intersection of fundamental quality with trend, that the market has a clear preference for quality. Now, this won't always be the case, and in fact, the risk of it changing is probably the greatest at the beginning of a new bull market, when you get what we perceive to be as the sort of the junk rally, where the world is not coming to an end, so everything that was priced to go out of business comes off the bottom. So, you know, we need to be mindful of that. But as it stands right now, quality is definitely the place to be. Okay, so last slide for you. The world is obviously obsessing over this market cap battle between Microsoft and Apple. And you can see that they're sort of two ships passing in the night right here, both hovering just below 3 trillion. It's interesting. It's kind of fun to talk about. It's fun to watch and whatnot, but it really is irrelevant on many levels, but not the least of which is, you know, this is not the first battle in the war. These two companies have been going at it for a number of years in terms of trying to secure the highest market cap between the two. So the truth is that this is just not relevant. While this is unfolding, the more important battle that's taking place is actually what we can see here. And we're looking at two expressions of the various investment strategies. One is active and the other is passive. And for the first time, this long heralded, long expected two ships passing in the night, it's happening, where we're now having more passive assets being managed than active assets. So I'm not necessarily certain what this is going to mean for how securities trade going forward. Maybe it won't mean anything at all. Maybe it will be quite meaningful. Nonetheless, I believe whatever it does do to markets, it will be reflected in trend. And our job is to just let the market figure it out and just follow what the market concludes. But nonetheless, this could be interesting as the control of the asset flows gets sort of overtaken by passive strategies. And obviously, some part of this is for sure the result of the Magnificent Seven. Most recently, we can see that the active managers are well away from their peak assets under management, whereas these two ships passing in the night are the actual are the result of the lagging of active assets being overwhelmed by passive by passive assets actually going off to new highs. And again, I think a lot of that probably likely does have to do with the Magnificent Seven, because these passive assets are very highly weighted to those mega cap stocks, whereas active managers surely own them, but they're not very likely. They very likely don't own them to the same extent in terms of exposure as do these passive strategies. So I'm sure that has something to do with it. But nonetheless, this is something we'll be keeping an eye on, certainly following throughout 2024 and the years ahead. But once again, it's our view that the market will figure it all out, and our job is to listen to the market as opposed to let our views influence what we do in the portfolios. Okay, so quick summary for you before we wrap up here. So the bull is back with cap-weighted indices confirmed by market breadth. This is the most important development over the past couple of months, where the breadth is finally in a position to confirm the gains that we're seeing in the cap-weighted indices. So I believe that this sets up 2024 for a decent year. So the bigger picture, though, is that the breadth of the market's basically been going sideways, as I refer to it, as chopping wood for 2 years. So that's a long time. You go back to, I showed this last month, but if you go back to the early 1900s, this 2-year window without a 2-year high has only happened 10 other times. So this is not a normal course of events for the market. So it tends to have a bullish bias once we get going again, and obviously we're getting going again. So I think that there's a good chance that what's going to happen is that this bull market is going to sneak up on a lot of folks, because they don't appreciate the fact that we've actually had a 2-year bear market, regardless of what the S&P says. So the idea, though, is that we have this massive pile of wood. It's just starting to get lit on fire, as I showed you with those risk gauges. The leadership's not even in risk on yet, so those piles of wood are just starting to catch fire. And that should give us plenty of fuel to drive us to our targets well north of 5,000. Leadership remains very cyclical, whether it's industrials, financials, tech, and then within other sectors as well. So I would start there for ideas as you're building out your portfolios, if you're not there already. But as always, focus on stocks with the best trade-off between growth and value, but never compromise when it comes to trending and outperforming. So let that be the starting point. Let's just find out what's trending and outperforming, and then go through those lists looking for stocks that meet your fundamental and valuation criteria. And I believe over time, that's the best way to proceed. And then lastly, with passive assets under management, now greater than active, I do think that things are going to get interesting in ways that I frankly can't really imagine at this point, but I suspect that things will be different as this mindless investing takes the wheel from humans. And not sure exactly how this plays out, but it will be worth following. But as always, listen to the market. That's the best way to navigate all these unknowns. Okay, thank you, and Happy New Year to all. Thanks so much for tuning in this month. Hope this was helpful. As always, if I can help with anything, or you need to reach out to me for any questions on this video or about the research, feel free to reach out to me directly at this email address provided here below. All right, thanks so much.